The time factor, as Livermore defined it, is not merely clock time or the passage of minutes in a trading day. Instead, it represents the necessary duration required for the market's underlying structure, accumulation or distribution, to fully complete its work. Livermore observed that while price can move instantly, the psychological shift of the public takes a measurable, often lengthy period to mature. He famously stated that money is made by sitting, not by trading, yet he often lacked the discipline to sit still during the preparatory phase that precedes the explosive move. Before we dive deeper into the mechanics of this costly error, please take a moment to subscribe to the channel and leave a quick comment below. Even just a single word helps the algorithm recommend this video to more people, showing me that this kind of detailed content truly matters and is worth creating. Furthermore, remember this channel is a resource, and I encourage you to return here during challenging times when trading becomes difficult and your confidence starts to waver. Your support ensures that these critical lessons from market history continue to reach those who need them most in their trading journey. Livermore recognized that market movements rely on two fundamental pillars: price action and the time factor. He became the undisputed master of the first, developing unparalleled skill in tape reading and identifying the line of least resistance. However, his repeated failure lay in miscalculating the second pillar, consistently attempting to rush the market's natural rhythm. The line of least resistance defines the primary trend, but the market spends far more time in preparatory phases than it does in trending phases. The critical error setup involves mistaking an intermediate reaction against the primary trend for the definitive reversal point. When a market pauses or corrects, this is often the necessary preparatory phase for the next major leg, not the immediate signal of a complete trend change. Livermore, seeking instant gratification or feeling pressure to be fully committed, often jumped in during these intermediate reactions. He failed to appreciate the necessary duration required for the foundational work of accumulation or distribution to finish. The concept of psychological time is central to understanding Livermore's mistake. He eventually realized that a market needs time for the collective public opinion to fully shift, regardless of how quickly the price might move in a single session. A sharp price decline, for instance, might exhaust sellers temporarily, but it does not instantly convert the majority of bears into bulls. That conversion requires the slow, grinding process of consolidation and testing, which demands significant duration. The specific mistake Livermore made was initiating a major position based purely on a price target being hit, without waiting for the necessary duration of consolidation or corrective structure to confirm the shift in psychology. He would see a stock hit a level he deemed cheap or expensive, and his confidence in his price analysis would override the prudence required by time analysis. This premature commitment exposed him to the volatility of the preparation phase, where the market seeks to shake out impatient participants. The market does not care if you are right on the eventual direction. It cares only about the timing of your capital commitment. The failure of anticipation was a constant trap for Livermore, specifically trying to guess the end of the dead time. Dead time is the period between the collapse of one dominant trend and the confirmed start of the next, characterized by choppy, directionless movement. This dead time is exactly where the time factor is most demanding, requiring the maximum amount of patience and restraint from the speculator. Livermore's impatience often led him to prematurely scale into a position during a reaction, believing that reaction was the definitive final leg of the correction. The painful mechanism of loss was often the resumption of the primary trend, which would liquidate his early commitment before the true reversal occurred. He would be forced out of the market, taking a substantial loss, only to watch the market reverse and move in his original anticipated direction weeks or months later. This confirmed that his price analysis was correct, but his failure to respect the duration of the preparatory phase was the sole cause of the financial damage. The scaling error meant he had too much capital exposed during the phase where the market was still highly uncertain. Consider the methodological example of his timing mistake, especially in his later years when he began to rely too heavily on fundamental valuation rather than pure tape action, Livermore often bought stocks or commodities that had experienced a sharp, painful decline, believing they were intrinsically cheap. He was essentially looking for bargains, a mindset that contradicted his own rules about trading the line of least resistance. This approach ignored the crucial need for the market to complete the time-consuming process of bottoming, which involves extensive accumulation. The consequence was repeatedly being right on direction but fundamentally wrong on time, leading to major margin calls while waiting for the inevitable move to materialize. The market would linger near the low, absorbing supply and testing demand, a process that might take 6 months or a year. During that duration, the volatility inherent in the consolidation phase would erode his capital through whipsaws and drawdowns. Livermore's capital, committed too early, was tied up and vulnerable during the exact period the market was still preparing its move. The market's preparatory phase is a structural necessity, not a random event, and it is governed by the time factor. The preparation zone exists to ensure that all weak hands are forced out, and that the large, informed operators can acquire or dispose of their full desired position without driving the price too far. This process requires a specific duration to be effective. If the market reverses too quickly, the necessary transfer of ownership has not been completed, making the subsequent move unstable and prone to failure. This brings us directly to the profound insights offered by the Wyckoff method, which systematically addresses the very timing failures that plagued Livermore. If you find yourself struggling to differentiate between a simple reaction and a fully completed accumulation or distribution structure, you need a deeper understanding of market cycles. We strongly recommend checking out the specialized Richard Wyckoff Trading Methods channel. This channel is entirely dedicated to the profound study of Wyckoff's methodology, providing detailed analysis of the accumulation and distribution cycles that Livermore failed to recognize in real time. By mastering the Wyckoff approach, you gain the tools to identify the specific phases of preparation, such as the spring or the test, which signal the end of the required duration. This knowledge transforms anticipation into confirmation, protecting your capital from the premature entries that ruined Livermore. The Richard Wyckoff Trading Methods channel offers comprehensive tutorials and real-world examples that turn theoretical concepts into practical, actionable trading rules. To finally conquer the market timing puzzle and integrate these essential structural analyses into your trading, follow the link in the description immediately. A critical distinction must be drawn between hitting a price target and fulfilling a time target. Price targets, such as the low of a selling climax, can be reached quickly, often in a single dramatic session. The time factor, however, demands confirmation that the energy causing the move is truly exhausted and that the new dominant force, accumulation or distribution, has taken root. This confirmation requires a longer duration of sideways movement or complex corrective action to prove stability. Livermore's personal realization was that he found it easier to wait for the market to run up or run down than it was to wait for the market to stand still. This inability to endure the waiting period, the stillness of the preparatory phase, was the critical timing failure that undermined his spectacular price analysis. The market standing still is often the most dangerous time for the impatient speculator, yet it is the most profitable time for the disciplined investor who respects the time factor. The temptation to do something during this quiet period is overwhelming, but action is antithetical to the required patience. This impatience led directly to the violation of his own confirmation rule. Livermore's system dictated waiting for the price to definitively break through a key pivot point, a critical resistance or support level, after a long period of preparation. The preparatory phase establishes the foundation, and the breakout confirms that the foundation is sound and the time factor has matured. The failure involved entering before the breakout during the messy, volatile, and uncertain preparation phase itself. Entering during the preparation phase exposes capital to unnecessary volatility and, critically, the risk of the primary trend resuming before the reversal structure is complete. By committing capital too soon, Livermore was essentially betting that the market was done preparing, a bet that the market consistently punished. The preparation zone is designed to inflict maximum pain on those who try to anticipate the final signal. True market readiness is signaled not just by price, but by the completion of duration. The instructional avoidance of this mistake begins with Method 1, defining the preparation zone as a crucial waiting filter. Traders must use price action to clearly define the required accumulation or distribution zone, identifying the boundaries of the consolidation range. This zone represents the required duration for the market to achieve stability and shift psychology. If the market is still trading within this defined zone, regardless of how long it takes, the time factor has not yet matured. The requirement here is forcing oneself to wait for a clear, decisive breakout that confirms the end of the preparatory duration. This breakout must be accompanied by volume and conviction, demonstrating that the large operators are finally ready to push the price in the new direction. The preparation zone acts as a quarantine area for capital. While the price is trapped within it, your capital must remain on the sidelines, protected from the internal volatility. This discipline transforms waiting from a passive act into an active, analytical decision. Method 2 involves using time-based confirmation signals, rather than relying solely on the immediate price reversal. While a sharp reversal might look impressive on an intraday chart, the time factor demands confirmation on higher time frames. Practical application means looking for confirmation that the volatility has collapsed, or that the market has held a specific consolidation range for a defined number of periods. For instance, if you are looking for a major bottom, the accumulation process must be visible and stable on weekly or monthly charts, not just daily charts. The duration required for a major reversal to confirm might involve the market holding above a key support level for 3 consecutive weeks, or demonstrating 5 distinct tests of the lows without penetrating them. These time-based signals provide the evidence that the required psychological shift has occurred and that the smart money has fully absorbed the supply. Focusing on duration forces the trader to prioritize stability over speed, a lesson Livermore learned too late. The time factor demands proof, and proof is built over time, not instantly. Method 3 concerns the fundamental discipline of position sizing. Applying the Livermore lesson means never committing full capital based purely on anticipation. If an early entry feels necessary, perhaps to establish a small exploratory position, the size must be small enough to withstand a return to the extreme price level without triggering a margin call or causing significant psychological stress. This acknowledgement respects the high probability that the market still needs more time to prepare and test the commitment of traders. The initial commitment should be viewed as a scouting mission, not a full deployment of forces. If the market continues to consolidate, the small position size allows the trader to endure the extended duration without pain. If the market moves against the position, the loss is minimal, confirming that the time factor was not yet complete. This approach mitigates the risk of being right on direction but prematurely liquidated due to impatience during the preparation phase. To implement this discipline effectively, traders must establish a clear rule that a majority of the position can only be initiated upon the confirmed breakout of the preparation zone, fulfilling both the price and time requirements. The small anticipatory position acts as a placeholder, but it never jeopardizes the overall capital base. Livermore's error was often scaling in too aggressively, treating the anticipation phase as the confirmation phase, thereby exposing his entire trading life to the uncertainty of duration. The successful speculator must train themselves to view the preparatory phase, the sideways, boring market action, not as a frustrating delay, but as the essential, necessary process that builds future profits. The longer the market takes to accumulate or distribute, the more robust and significant the subsequent move is likely to be. Impatience during this phase is the direct cause of financial ruin, as capital is tied up and vulnerable to volatility designed specifically to shake out the early birds. The market rewards those who wait for the duration to complete its work. Another critical instructional step is using volatility contraction as a time-based signal. During the initial collapse of a trend, volatility is high, and price swings are wide. As the market enters the preparatory phase, the required duration manifests as a noticeable contraction in volatility. This contraction signals that the psychological battle is winding down and that supply and demand are nearing equilibrium. If volatility remains high, the preparation phase is still incomplete, regardless of how many price targets have been hit. The time factor demands that the trader observes the pace of the market, not just the level of the market. A market that is prepared to move decisively will often exhibit a period of extreme quietude before the explosion. Livermore often missed this quiet phase because he was too focused on the dramatic price swings that preceded it. Learning to love the quiet, boring, sideways action is synonymous with mastering the time factor. The quiet period is the market fulfilling its duration requirement. Traders must also systematically review historical examples of major market reversals, specifically noting the duration between the selling climax and the ultimate breakout confirmation. Rarely does a major low or high form instantly. Almost universally, it involves months of consolidation, testing, and volume absorption. By studying these historical durations, the modern trader can calibrate their expectations and avoid the trap of premature commitment that plagued Livermore. Expecting a major trend reversal to complete its preparation in a matter of days is a recipe for failure. The duration of the preparatory phase is directly proportional to the significance of the move that follows. A minor reaction might require only a few days of consolidation, but a major reversal of a multi-year trend requires a substantial duration of accumulation or distribution. Livermore often failed to match the scale of the expected move with the necessary scale of the time required for preparation. He sought large profits, but was unwilling to invest the necessary time. Respecting the time factor also means employing time stops, not just price stops. While a price stop protects capital if the market moves against the position, a time stop protects capital if the market simply fails to move. If a position is entered based on the expectation of a move and that move fails to materialize after a predetermined duration, the position should be exited. This discipline prevents capital from being tied up indefinitely in markets that are stuck in extended preparation zones. A time stop recognizes that opportunity cost is a real financial loss. If capital is held hostage by a market that needs endless duration to prepare, that capital cannot be deployed elsewhere in a market that is ready to move. This practical application of the time factor ensures efficiency and active capital management. Livermore's failures often stemmed from holding positions that were right, but paralyzed for months, draining his mental and financial reserves. The instructional takeaway here is to treat the time factor as a non-negotiable component of your trade entry checklist. Before initiating any position, the trader must be able to articulate not just the expected price target, but the expected duration required for the preparatory phase to complete. If the market has not demonstrated the necessary accumulation structure or the required period of volatility collapse, the trade is incomplete and must be deferred. This structured patience is the ultimate defense against Livermore's timing failure. The final powerful rule of duration is this: the market is never in a hurry to confirm your genius. It will take exactly as long as it needs to take to redistribute ownership and shift the psychological balance. The speculator's job is not to rush this process, but to observe it patiently and wait for the definitive signal that the duration requirement has been fulfilled. The temptation to anticipate the end of the dead time is the greatest psychological hurdle a trader faces. In summary, the greatest market mistake is confusing price readiness with time readiness. Price can crash instantly, creating a temporary extreme, but time, the slow, grinding process of the psychological and structural shift, always takes longer. The rapid price move is the symptom. The duration of the subsequent consolidation is the cure. Livermore's genius was in recognizing the symptom, but his downfall was in failing to wait for the cure to take hold. The ultimate lesson derived from Livermore's spectacular career is that patience is not merely waiting for the price to move. Patience is the analytical discipline of waiting for the market's duration requirements to be fully fulfilled. This fulfillment is confirmed by the completion of recognizable preparation structures and the definitive breakout from the consolidation zone. Respecting the time factor means acknowledging that the market's clock runs differently than the speculator's ambition. For those who wish to delve deeper into the mind and methods of the man who coined these indispensable rules, we have a unique offering. We highly recommend the new edition of Reminiscences of a Stock Operator. This classic work by Edwin Lefebvre offers the deepest analysis of Jesse Livermore's psychology and strategies, providing a direct window into the very mistakes discussed here. Unlike previous versions, this new edition is supplemented with unique practical commentary and a detailed breakdown for every single chapter, transforming Livermore's historic experiences into actionable lessons for contemporary traders. This book is not just a history lesson. It is a practical guide to avoiding the psychological and timing failures that derailed the greatest speculator of all time. You can find the link to this essential annotated edition of Reminiscences of a Stock Operator in the description below, ensuring you learn these critical lessons firsthand. Mastering the market requires internalizing the fact that time is the market's ultimate weapon against the impatient. Use the lessons of the preparation zone and the confirmation rules to shield your capital from the volatility of anticipation. The market will eventually reward your patience, but only if you allow the necessary duration to complete its vital work.